If I asked you to describe the first half of 2026 in one word, most people would probably say chaotic. Think about it. We had war in the Middle East, inflation made headlines again, oil prices surged, a new Federal Reserve chair, political uncertainty, and AI dominating every financial conversation. And somehow, despite all of that, the stock market finished the first half of the year near all-time highs. That's the lesson. The market doesn't reward people who predict headlines. It rewards people who stay invested through them. Let's look at some lessons. Lesson number one, headlines are temporary, businesses are permanent. I think investors often forget something incredibly simple. When you buy a stock, you're buying ownership in a business. Not a headline, not a political opinion, not a cable news segment. Businesses continue hiring, serving customers, creating products, earning profits. That's why the market can rise while the news feels terrible. Lesson number two, the economy is aging, but it isn't weak. This surprised me. The current economic expansion is now entering its 7th year. Normally when people hear that, they assume it's about to end. History says, not necessarily. Some of the strongest expansions in American history lasted well over a decade. The economy certainly isn't perfect. Inflation is still elevated. Interest rates remain higher. Consumers are frustrated, but people are still working. Companies are still investing. Businesses are still making money. That's what ultimately matters. Lesson number three, diversification quietly worked. This may have been my favorite takeaway. Everybody loves talking about whatever investment is hottest. This year it was AI. Last year it was something else. Next year it will be something different. Meanwhile, diversified investors quietly kept winning. Large companies did well. Small companies participated. International markets contributed. Emerging markets had an excellent year. Commodities played their role. That's exactly how diversified portfolios are supposed to work. Lesson number four, volatility isn't the enemy. I want to ask you something. Do you remember how uncomfortable March felt? Most investors do. Markets sold off. Everyone started wondering if another correction had begun. Today, most people barely remember it. That's because the market recovered and went on to make over 20 new all-time highs. The decline wasn't the risk. Reacting emotionally to it was. Lesson number five, cash feels safe until inflation shows up. This is one stat that really caught my attention. Americans now have almost $8 trillion sitting in money market funds. I understand why. Cash feels comfortable. It doesn't fluctuate every day, but there's a problem. If inflation is running faster than your cash earns, you're quietly losing purchasing power. It's one of those risks you don't notice until years later. So where do we go from here? Three main things. First, corporate earnings. Earnings have been the fuel behind this rally. As long as businesses continue producing profits, that's a positive backdrop. Second, the Federal Reserve. Interest rate policy will continue driving headlines. And third, the midterm elections. Markets historically don't love uncertainty, but uncertainty and permanent damage are two very different things. This is where planning becomes more important than predictions. At Frame Wealth Partners, our conversations today aren't about trying to guess where the S&P 500 finishes this year. Instead, we're asking questions like, should we be harvesting gains? Does this create Roth conversion opportunities? Should concentrated stock positions be reduced? Do we have enough cash for the next several years of spending? Can we lower taxes over the next decade? Those decisions often create more value than trying to predict the next 5% move in the market. I'll leave you with one final thought. There's an old saying, smooth seas do not make skillful sailors. I think that's a perfect description of investing. Nobody enjoys uncertainty, but every successful investor eventually learns that uncertainty isn't something to avoid. It's simply the price we pay for long-term growth. The first half of 2026 rewarded disciplined investors. History suggests the second half will reward them as well. As always, if you'd like to discuss your portfolio or your financial plan, we'd love to have that conversation. Thanks for watching. We'll see you next time.